Brexit update. How is it affecting the economy? It has been a little over 5 years since the citizens of the United Kingdom went to the polls to vote on whether to leave the European Union. A non-binding referendum that most observers saw as little more than an opportunity to silence a vocal minority shocked the world when it came back in favor of the decision to leave. 3.5 years later, after a long and grueling period of negotiations, the United Kingdom finally left the EU, ending its 47 years of membership. At the time, there were widespread concerns that this would impede people from traveling back and forth to the UK, had the potential to shut down some businesses, particularly those that served frequent travelers from the EU, and, most importantly, threatened the living standards of average Britons who had benefited from EU membership, whether they realized it or not. Obviously, all these concerns have come to pass to some extent, but not necessarily because of Brexit, but rather because of the global pandemic that hit the country particularly hard during the period leading up to the actual exit day. This made it difficult to assess what difficulties were being felt due to Brexit and which difficulties would have been felt anyway due to the pandemic. With the same logic and in the interest of fairness, it makes it difficult to determine if the promises made by Brexit supporters were grounded in reality, given that even the best economic plans would have struggled in the global economic environment of 2021. So, how much damage has Brexit done to the UK's economy? Did the UK benefit from Brexit happening during the pandemic? And finally, what will all this mean for the UK's ability to recover from the pandemic once all is said and done? We can put the UK in the economic rankings, explained by the National Leaderboard. Now, one of the biggest problems that the UK had to deal with in the years between the referendum and the actual exit from the EU was the uncertainty about what post-Brexit UK would actually look like. There were a range of conflicting theories suggesting everything from a kind of British utopia finally free from the shackles of the continent to an Armageddon complete with street riots and empty shelves. Naturally, the second option doesn't sound great, but what could have been worse was not knowing in which direction the country was going. The most immediate and biggest impact of Brexit would have been on trade. The European Union is first and foremost a free trade union. Countries within the Union all agree to trade with each other without imposing tariffs or import quotas. This is further facilitated by the fact that most remaining members have used the same currency, the euro, since its introduction in 1999. On the flip side, the EU imposes heavy restrictions on trade with third countries as a way to incentivize EU members to trade with each other rather than with an outside country. This still happens, and exceptions are made for some goods and materials that are not abundant in the EU. Gas from Russia that powers Germany is a perfect example of this. Now, I won't get into the advantages and disadvantages of free trade in this video because that's not really the point. Regardless of whether this type of free trade region is advantageous for its members, the UK is now an outsider. It has gone from being the beneficiary of free trade agreements to the victim of harsh trade restrictions. This wouldn't be good for any country, but it is particularly negative for the UK, given how much they depend on trade to sustain their economy. To understand how important this is, look at a figure called trade intensity. When economists look at trade figures, they normally focus on net trade, as in exports minus imports, if we want to calculate GDP. We look at the total sum of consumer spending plus government spending plus investment and net exports. Net exports also make up the trade balance and, by extension, things like current account balances. So, it's easy to see why it receives a lot of attention. But consider this. Imagine two countries, one that has no imports and no exports, completely isolated. Then imagine a country that imports $1 trillion of goods in a given year and exports an equal value of goods worth $1 trillion. Both of these countries would have exactly the same net export figure, but the second example would probably be faring much better. An export value of $1 trillion would require the employment of millions of people, and an import value of $1 trillion would significantly improve the average standards of living for those same workers. The second country would also naturally be much more dependent on free trade agreements. That's why it's important that economists consider figures on trade intensity. Trade intensity is simply the total sum of imports and exports divided by GDP. So, if we take our simplified example of these two countries here, suppose they both have a GDP of $4 trillion. Then the first would have a trade intensity of 0%, while the second would have a trade intensity of 50%. You can see clearly that trade intensity is often a much more indicative figure of what is really happening in an economy. So, why is this important for the UK? Well, the UK has one of the highest trade intensity levels in the world. The UK's trade intensity was 63 in 2019. Compare that with other major advanced trading nations like Australia at 46, Japan at 35%, and the United States at 24, and you can start to see how important trade is for the UK. Historically, this makes sense. The UK itself is a relatively barren rock in the middle of the Atlantic, lacking many of the natural resources it would need to adequately fuel its economy. It has also historically been a major colonial power, so trade is something that came naturally to it. As it became increasingly important for the global economy over the last few decades, this is where the uncertainty about what Brexit would look like becomes really important again. A worst-case scenario like the much-feared no-deal Brexit with hard borders and no free trade between the EU would not have been positive, obviously, but it would have been possible to plan for. Say you run a tool manufacturing business. You have a small factory in a warehouse, and you mainly ship high-end mechanical equipment to other businesses in the UK and across the EU. Once those referendum results came in, you would have been put in a rather difficult situation. Without a free trade agreement in place, you would no longer be competitive in Europe because you would have to pay import taxes on all the tools you sell there. You could get around this problem by opening a separate factory in the EU, but that would be a huge investment of capital. And if it turned out that the UK was able to negotiate a favorable trade deal with the EU, then it would have been an investment made for nothing. You could also save money by just having money on hand ready to buy a factory quickly if needed, but then you have a pile of money sitting around that isn't being reinvested in the business, paid to new employees, or even sent out as dividends to your investors. Money that sits waiting for something to happen doesn't help the economy. Money used for any of these purposes does. If business owners knew what was happening, even if it wasn't good news, they could take measures to deal with it. The combination of a prolonged decision to leave followed by a one-year transition period combined with the existing economic fallout of the global pandemic has made it incredibly difficult for individuals, businesses, and even entire governments to plan much beyond the immediate future. But obviously, now that we have the benefit of hindsight, we can actually look at a proper before and after of Brexit. Trade has decreased significantly, no surprise, especially considering the impact of the pandemic on things like travel and general business activity. Trade intensity fell from 63 in 2019 to 55 in 2020. This might not seem like a huge drop, and it still places the UK well above most other nations, but this figure was recorded during the so-called Brexit transition period. That period is now over, and the UK's trade relations with the EU are now defined by the UK-EU Trade and Cooperation Agreement, or TCA for short. The timeline is that the UK officially left the EU at the beginning of 2020. The transition period agreement was then in place until the end of 2020, and now the TCA has been in force for a little over 11 months. The terms of the TCA, which is only partially in force at this point, are in general much more restrictive than the terms of the transition agreement, and the terms of the transition agreement were in turn much more restrictive than being a full member of the EU. It is obviously less restrictive than a no-deal Brexit, but perhaps not by much. Goods exports to the EU have decreased significantly this year, which means that trade intensity could well see another 10-point slide in 2021. On the Conservative front, the Centre for European Reform has attempted to isolate the impact of Brexit using a statistically modelled doppelganger of the UK to assess what would have happened if the UK had remained in the EU. Such analysis concluded that from the end of the transition period, leaving the single market and customs union had reduced the UK's goods trade by 15.8% by August 2021. 15.8% is enormous. This will have a direct impact on hundreds of thousands of workers, and not in a good way. Now, despite being the first thing that everyone thinks about, the loss of trade might not actually be the biggest blow to the British economy. Rather, it could be the loss of labor. You might have seen the headlines about empty gas stations and gas stations refusing customers in the UK right now. Well, this was caused by a severe labor shortage. The UK is short about 100,000 truck drivers, many of whom were non-British citizens working in the UK under the EU's shared labour agreement. See, before Brexit, any citizen of any EU country could live and work in any other country they desired within the EU. This had some important advantages, like companies being able to draw on the best and brightest from a wide labour pool, and it also had some disadvantages, like the brain drain that drew promising young workers from poorer countries to richer countries where they could earn more, further increasing the gap. I can really see the arguments for both sides here, but despite all this, truck drivers were one of the most represented groups of workers that benefited from this policy. Truck driving in general lends itself to being on the move. When you combine this with free trade agreements over a relatively small territory and language barriers not being a big problem for driving a truck around, it's no surprise that many European truck drivers basically went where the demand was. This meant that overall, the EU needed a smaller fleet of trucks than would have existed if all these countries kept all the trucks they needed throughout the year. The downside of this is that when the UK left this shared labour pool, it was cut off from the workers it needed to run the country. The same problem is becoming evident with other seasonal workers, especially in agriculture, where workers from across the Channel were responsible for a large part of the harvesting activities that happen 1 or 2 times a year. This is raising concerns about empty tables at Christmas this year, which is leading to panic buying that is further accelerating the supply chain shortages the country is facing. The government has tried to solve these problems by granting 5,000 3-month emergency visas to truck drivers and putting military drivers on standby if things get really bad. This drop in employment and consumption has cost the government about £30 billion, a little over $41 billion, in lost tax revenue. Coincidentally, this is roughly the same figure that was raised by introducing new tax measures at the beginning of this year. A higher tax burden during a period of economic turmoil is the exact opposite of what most economists recommend, but the money has to come from somewhere. The UK's fiscal watchdog, the Office for Budget Responsibility, has forecast that all these factors combined will mean that Brexit will result in a 4% reduction in the UK's long-term GDP, which adds to a 2% reduction in GDP that is expected to be caused again by the pandemic. It might not seem like much, but the UK actually hasn't had sustained growth since the global financial crisis. This 4% drop could really set its economy back by over a decade. Well, now it's time to put the UK in the national economic rankings, explained starting with GDP. The UK is the 5th largest economy in the world with an annual output of over $3.1 trillion. It is still well below the true superpowers, China and America, and comfortably behind Japan and Germany, but it still gets a 9 out of 10. Such production is distributed among 67 million people to give the country a GDP per capita of just over $46,000, which is fairly in line with its old European peers like France and Germany and gets a 7 out of 10. Stability and confidence are really hard to say, obviously. This is a completely subjective measure. The country is obviously going through some turmoil, but it has historically been considered one of the most stable nations in the world, especially for things like the banking system. We actually made an entire video on this not too long ago, so go check it out if you're interested. It's still an advanced nation with solid laws, a good financial system, a well-regarded currency, and a functioning democratic system, so it gets an 8 out of 10. 5 years ago, it would have been the easiest 10 out of 10 ever. Growth hasn't been exceptional, as we saw earlier in this video. Its GDP is still below its previous peak in 2007. Since then, it has been a victim of the global financial crisis, the Eurozone crisis, Brexit, and the pandemic. It is certainly resilient and hasn't fallen much, but it hasn't grown. It gets a 3 out of 10. Finally, industry is surprisingly strong. The UK still hosts a healthy industrial sector that produces everything from luxury sports cars to cutting-edge jet engines. It is also home to the second largest financial center in the world, so the country gets a 9 out of 10. In total, this gives the United Kingdom a very healthy average score of 7.2 out of 10, placing the nation in third place in the rankings alongside France, the Netherlands, and Taiwan. Share your personal experience on today's topic with us. Write it in the comments and ask us any questions you may have, we will be happy to answer. Leave a comment so that we can perfect our creations. We will be happy with your simple like, but the most important thing is not to forget to subscribe to the channel so you don't miss the upcoming videos.